Hello traders, the title of the video is Elliott Wave Trader clearly explains the X-Wave. Alright, the X-Wave, X for X-ray. The X-Wave, alright. Let me write it here for you. What is the X-wave of the Elliott wave correction? Have you ever heard about the Earth wave? Yes? Good. Today I will explain to you, alright, what is the X-wave. Alright. But before I explain to you the X-wave, I will show you on this chart the X-wave. I'm writing on my chart X-wave. Can you see X-wave written on my chart? Beautiful, isn't it? Beautiful and gorgeous indeed. Okay, so here we have X-wave. Now, so I'm on the monthly chart of Macronet Inertech Technology Incorporation, Macronet Inertech Technology Incorporation, EPIC MICT, Mike India Charlie Tango, belonging to the industrial sector. And we can see that if I have enough data, if I am not missing any data, I will say that this is the trending first. So and the reason why I'm speaking like this is that if you see a chart like this, be very cautious, all right? So if you do not have enough data and then you are counting wave, you may, all right, have a wave count that is not valid. So always be aware of the data that you have so you do not fool yourself, okay? So looks to me this is a trending first, followed by a sharp correction. You remember? What usually takes place after a sharp correction? Should click now. Dead cow bounce. So, yeah? Here it is. This is the dead cow bounce. Okay. And then you will expect one more down after the sharp correction. Usually, alright? Usually. 70% of the time, you'll see that. So this is a trending phase followed by correction, sharp correction, 1, 2. Okay, so it's 1, 2, 3. The first part of the 1, 2, 3 is the sharp correction followed by the dead cat bounce and another move down. All right, so when Elliott wave trader were here, all right, somewhere in 2013, they were expecting Macronet Inertech Technology to begin a new trend. I'm going to place a vertical line there. But as that trend has started, it did not go far. It stopped there. So I'm going to place another vertical line there where the trend has stopped. So traders say, well, there's no trend. It stops, all right? So then we have again 1, 2, 3, another move down. After that trend that has failed, we have another 1, 2, 3 down, because in the mind of Elliott wave traders, whenever they see the price action subdivided into 3, the first thing that is coming to their mind is that possibility that we may have a reversal. So based on market stable data, minimum price boom is what? 3. So here, nothing wrong to expect a new trend. Okay, so the trend has failed. They say, all right, correction continues, 1, 2, 3. So when they were here, trader will be expecting a new trend. But that's what we got, 1 month trend. Didn't happen. All right, so traders say, all right, it's not happening. So, because it's not happening, it means that the correction may continue. The Zigzag trader understood, Elliott wave traders understood that the minimum price move is 3. Again, they're expecting that 1, 2, 3 correction down. Well, as the price dip down 1, 2, 3, they say minimum price move is free. So they say priority to bullish signal above the low of that minimum price move free, and priority to bearish signal below. So traders were expecting again a new trend here, but that trend did not materialize here. It did not happen. I want to place my vertical line a little bit to the side here, so you can see that this candlestick bar went up a bit. Because if I put on it, am I zooming enough? All right, hold on, please. Better. You want to see this side also? So here they were expecting again a new trend, didn't happen. So what do we expect? Probably that the correction will continue. As long as there is room for the price to go down, because if there's no room for the price to go down, well, we can expect another 1 to 3 if it is very, very close to the penny stock, all right, 0.0001. There's not much room for the price to go down, yes or no? We don't have negative price, so as long as there is room for the price, we may say probability that we may have again 1 to 3. So there was a trend followed by sharp correction, 1, 2, 3 down. People were expecting a new trend, did not happen. Why? Remember, in order to have a new trend, one must have, okay, a bullish market environment, okay, strong economic environment, very, very important, and strong fundamental, talking about the financial instrument that we are trading. Without those two conditions, we may not see any trend at all, though technically we have a bullish trading setup. All right, 1, 2, 3, correction finish, minimum price move is free. People were expecting a new trend, didn't happen. Though the market was bullish in 2014, talking about the S&P 500, probably this stock, something did not work. I don't know whether it's the management, the competition, or the fundamentals, all right? But something did not allow the trend to continue. All right? If you want to find out why, you could need to go to Google Finance or Yahoo Finance. So trend did not happen. Remember that the title of the video is Elliott Wave Trader clearly explain the X-Wave. So the X-Wave is a trend that the market participants were expecting but did not take place. So it's a failure of the trend after a correction. The X-Wave is the failure of the trend after a correction. So here, this wave here, that's what we call the X. So now we have again another correction, 1, 2, 3. We were expecting a trend here. That trend has failed. That's again X wave. Again, 1, 2, 3. We are expecting a new trend here. And we do not have that trend. And we have X. That trend has failed. What I say to traders always should click into your mind. Whenever you talk about correction, you ask the question, what is it correcting? Otherwise, you can make a mistake and call something correction that is not correction. That's I would say to you that's the worst Elliott wave trading mistake, to call something a corrective wave that is not correcting anything. But yesterday, I think in one of the videos that I recorded, you may not see a prior trend, but if, for instance, a company is listed for the first time, which means initial price public offering, IPO, all right, the market may reject that price, okay, the initial price, all right, and you may see a correction. Though you do not have a prior trend, the market rejected that initial public offering price, and we have a correction relating to that price instead of a trend. All right. So now we say that this is a failure of a trend. But if the X wave will be corrected, understand that. So we have a zigzag pattern. This zigzag pattern, what is it correcting? The first one is correcting this trending first, this one here. Okay? The prior trend is trying to correct it, 1, 2, 3. Then we were expecting a trend, which is the failure of that trend, is the X wave. Now, the new correction that we have now, 1, 2, 3, what is it correcting? It's correcting the X wave, this one. Some trader may say, George, it's not correcting that X wave, it's correcting the prior trend. I'll come back to that in a minute, all right? Then we were expecting another trend here, and that trend has failed. That's another what? X-wave. So, again we have 1, 2, 3. What this zigzag pattern is correcting? It's correcting this X-wave here. This is what is correcting. Then we are expecting a new trend here. That trend has failed. That trend, because the trend has failed, a correction is likely to continue as long as we have enough room for the price to go down, or if the condition for that financial instrument, the condition did not change. All right? If the condition changed, the price will start going up without forming the 1, 2, 3. So, for instance, so don't get caught. Don't think that definitely the price will definitely form 1, 2, 3. Yeah? Remember, don't interpret that rule that the minimum price move is free. That when you have one move down, okay, definitely you will count to 3. If the price forms a support and form a double bottom chart pattern up here, it can go up. But the reason why we use the minimum price move free is that if it goes down 1, 2, 3, here we can now say its minimum price move is free. So we draw a line, we say priority to bullish signal above and priority to bearish signal below. So this move up is another X wave, a failure of an expected trend. That trend did not take place, is X wave. Now we have a correction, 1, 2, 3. What is it correcting? It's correcting that trend that has failed, which is the X wave. Going back to the trader that disagree with me, saying that this is not correcting the X wave. To a certain degree, maybe it's correcting the X wave, but all this from here, so 1, 2, 3, X, 1, 2, 3, we are here. So we will be saying at this point in time we have what? A double zigzag or a double tree here when we are here. So because 1 zigzag, X, 1 zigzag, that's a double zigzag, okay? Then we have another X, and then we have again a zigzag. So here we will be talking about triple tree, triple zigzag. 1, 2, 3, X, 1, 2, 3, X, 1, 2, 3. That's a triple tree, triple zigzag. All right? So triple tree or triple zigzag. So here we can say we have 4 zigzag. This is a combination of zigzags. All right? Combination of zigzags. All right? But from here, okay, if you accept, I'm moving this one from here all the way down here. So I color this one into red so to differentiate what is happening here. 1 second, traders. Alright, so from here all the way down there we have a correction, but it's a complex correction formed of 4 zigzags. It's a complex correction. So from here down to this point, it's a correction that is correcting the trending phase. Alright, it's correcting the trending phase. Though from here, all together correcting the trending phase, but this zigzag here is correcting that X wave. But this price action starting from here all the way down here is correcting the corrective wave. But the initial correction here, 1, 2, 3, is also correcting the corrective phase. So have I explained to you clearly what is the X wave? Is a trend that one is expecting after a corrective wave, but a trend that has failed. That a trend that has failed will be corrected. Now talking about the X is also a wave that connects 2 different corrective waves. So we can have X between a triangle, all right, and a zigzag. X connecting 2, a flat correction, X connecting a zigzag, and a flat correction. Why? Because you may have, for instance, a trending phase, all right, And then you see now, you say, okay, George, I've seen it 1, 2, 3, beautifully done, George. You said it. You are the man. I love you, George. And then you have 1, 2, 3 up above the high or the fifth where you say, George, I know what's going to happen. That's the fifth. That's the spinal flat correction I'm expecting. And then you see down, you come down 1, 2, 3, 4, 5. Exactly at 200% Fibonacci extension level of the A part of your flat correction. And you say, wow, George, you are the man. I'm speaking as to make you laugh a bit, all right? Don't be too serious, my friend. What's going on with you? Okay, what's wrong with you, all right? We're in London. Try to smile a bit, okay? All right, so you see now, you say, okay, Joe, this is the flat correction. We have the trending first. Color into orange. That's beautiful color, all right? Then we have the flat correction. Color it into red. So I explained to you that the X wave is a trend that has failed after a corrective phase. But now what I'm trying to explain to you, the S wave is also the connecting wave between two corrections. Have I spoken okay, a beautiful English to you? So you can see here that X wave is connecting two corrective waves. Zigzag connected by the X to another zigzag. Here we have again another X connecting this zigzag to this zigzag. But sometimes you may have that X connecting a flat correction to a zigzag or to a triangle. It's a wave that connects, okay, corrective waves. All right. So if you are an electrician, you should know a bit about connecting things. All right. So the reason is you have a trending first and you see a clear-cut, neat corrective wave. You say, probably we're going to have a new trend. But market environment did not help, or fundamentals did not help, or something, the company is going to a huge competition, or there is a price war. All right, as we have seen it recently, Under Armour, there is a price war between Under Armour and okay Nike at the moment. All right, so there's a competition, or something has forced the price down, has suppressed the price, so the trend did not happen. So instead of having a new trend, we have okay a failure of a trend. That failure of a trend, that's what we call the X. But that X will connect a corrective wave, in this case you see a flat correction, may be connected to a zigzag pattern. 1, 2, 3. So after the S, we see another correction that is formed, and this time we see a zigzag pattern. So we say, okay, probably we're going to have a new trend again because another corrective wave is completed. Now we are expecting a new trend, and that trend is not happening. Now we have what again? X wave. It's the connecting wave. And then we have probably after the S wave a triangle. So we have flat correction connected to a zigzag connected to a triangle connected to a flat correction. You can do all sorts of combinations. Now sometimes they may say you can't have that one and that one connected together. Then I'll say, all right, we're in the financial market, anything is possible. All right. So that's about the X wave. But before I close this video about the X wave, talking about Elliott Wave Trader clearly explains the X wave. As you can see here, this stock was going down, which means that we have a complex correction with the main, how many X? 3X between, okay, 4, okay, zigzags, all right? So as the correction is going down, okay, you want to know the ultimate target where that complex correction may end. Rule number 1, the ultimate target for a complex correction is the 138.2% Fibonacci extension level of the prior trend. So I recommend to trader to use that Fibonacci extension on the yearly chart. So here we are. Oops, I'm doing it. Hopefully I'm not missing enough data. All right, hopefully. So I assume that that's where it started because I don't know what has happened here or whether, okay. So here it is. So apply Fibonacci extension. I did not put it. You remember I mentioned this before. There are traders do not draw their Fibonacci extension the same way. Some traders will put it from the top to the low, and some will put it from the closing price to the closing price. Okay. So I'm putting it from the closing price to the closing price on the yearly chart. I recommend that. Closing price to the closing price on the yearly chart. I recommend that. But you can also put it to the top to have a bit of a idea what other traders are looking at. All right. So now I'll put it like this, and then I will highlight the 138.2% Fibonacci extension level of the prior trend. If the 138.2% Fibonacci extension level, okay, goes into negative price level, it becomes useless because the price cannot become negative. We can't have negative price. The price is always positive, so the price cannot go below zero. All right, that's what I meant. All right. So if you have your Fibonacci extension on your chart and it's showing negative price, you can just assume that if the price is already a penny stock, almost near zero, so you'll call that your 138.2% Fibonacci extension level. But all this story about 138.2% Fibonacci extension level is about when you have a complex correction going on, you wonder, where is it going to end that correction? All right. I refer you to a video that I posted today. Watch the full length of that video. Promise me now that you will watch the full length of that video that we title How to Forecast the End of the Area Wave Correction. If you watch half of it, you'll miss something. Watch the full length of How to Forecast the End of the Area Wave Correction. So in that video, I explained to you more about the 138.2% Fibonacci extension level. That's the ultimate target. Doesn't mean that definitely will change direction there, but that's the level everybody's watching. If it's going down, it breaks below the cycle point. The cycle point of the prior trend, and it continues to go down. We are watching a 138.2% Fibonacci extension level. That's where the stock is now. Does it mean that one should buy this stock straight away? No. One will go and check the Google Finance, fundamental solely, pass Google Acid test. Most importantly, where is the S&P 500 now? It's in a triangle. Anything is possible. All right? So, personally, the market is a little bit too high at the moment. We need to go above that triangle before we can, all right? We can become a little bit too bullish again. So one should be a little bit cautious because the market is giving a warning as the S&P 500 is in a triangle. So now, personally, if you ask me, George, all right, so I see that it's a 138.2% level, perform a Google Acid test, check the fundamental, check the competition, check the management, do your due diligence. All right, so you say, all right, George, I like it fundamentally speaking, everything is look good. All right, I like this, I like the story. What is the competition going through? Why this stock, no one is buying it since 2013? There's a reason why it's going on. All right, I don't know, so find out. And now, because the market is in a triangle at the top, all right, I will hold. That's what I will do myself. I'm not telling you to do that, but that's what, if you ask me, that's what I will do. All right. So this is about the X-wave. It's the wave that is connecting, okay, two or more corrective wave. It is the X-wave is also a trend that has failed after a correction because the correction is being prolonged. All right. Fundamental probably were not. I say probably were not solid, or market environment not viable or bullish. A trend has started but has failed. All right, that will form the S wave, which will connect the first corrective wave to the next corrective wave. The opposite is also true in a downtrend. All right, so in a downtrend, so if I do it here, you will see the X will be going down. You see, okay, so. All right, you're expecting more bearish trend, so the X will be going down. So in this case, we have a downtrend, and then you have your first correction, which is a zigzag, for instance, and your X. So at the end of that zigzag, you're expecting a new bearish trend because you are a die-hard bearish trader that everybody hates. You always like to sell. Why? You shouldn't. The normal Okay, some traders do not buy at all. They always sell. I think my friend, my Australian friend, they like to sell a lot. All right, the Americans hate to sell, but the Australian, if they're going to sell, stay away, don't buy, because the Australian they sell madly. Now, are you an Australian? Or I'm not making fun of you. I'm just telling the truth. So here is a downtrend was in place, so we see the first correction, all right, zigzag or a flat or a triangle. Now, at the end of that first correction, all right, we are expecting a new downtrend because we believe that nothing has changed. Market is still bearish, fundamentals still weak. Management does not know what's going on, all right. So we start selling. As we sell it, all right, the market becomes resilient. So you sell it, all right. All right, it's like selling Johnson Johnson. Recently, they went down because of another litigation relating to one of their products. But some stuff you want to sell them, it's crazy to sell some stuff. They're just going up. All right, so you sold it. You think that okay, that corrective wave has ended here in a down after a downtrend. You say you want to sell again, so you sell. All right, phew. It's going down. You're expecting a proper bearish trend when you can sell like a crazy bear, all right? Jumping all over the place, selling like a mad bear. But the trend has failed. Close it, all right? Don't force it, all right? Because the bearish traders sometimes they don't like to close their position. Close it and go. Now you have again another zigzag 1, 2, 3, and you say, I told you that this stock is not going anywhere, that it's going to go down. But again, you are expecting a downtrend, but that trend doesn't go far. You have another X. Now you see in a downtrend how it can be tricky for somebody that is selling when the stock is still pushing it up. Okay, this is the opposite of what is happening after an uptrend. So the correction is going down. Yeah, after a downtrend, the correction is going up, pushing. Okay, the bearish traders out. In that case, one more time, you will apply Fibonacci extension to the prior trend, the trending first, and you will highlight the 138.2% Fibonacci extension level, which will be above the low of, okay, the first wave. All right, so the first wave is somewhere in here, all right, which is also corresponding to the cycle point. But your 138.2% Fibonacci extension will be a little bit above that level. So as you see that the correction is being extended, you have many X connecting various type of correction, forming what we call a combination. All right. Your ultimate target for the end of that complex correction will be the 138.2% Fibonacci extension level above the low of the first wave, contrary to the situation that we have, okay, during an uptrend. Well, this is the end of this tutorial about Elliott wave trader. Clearly explain the S-wave. Do you think that I have clearly explained the S-wave? All right. If you think so, all right, feel free to give us the thumbs up, and most importantly, to share it with your friend on Twitter, on Facebook, and also on Google+. Now, if you think that, George, you have done a very bad job today, all right, I want to know, all right, give us the thumbs down so I know that, oh, how many people dislike this video? George, that's another blah, blah, blah from my side. So I am under pressure. So next time, I'll do better, okay? So thank you for watching this tutorial. As always, okay, do not hesitate to put your question below, and I will get back to you in due course. We are the TSTW24 traders talking about Elliott wave trader. Clearly explains the X-wave. The wave that is connecting corrective wave, which is also a failure of a trending phase that has failed after a correction. Happy trading to you all, and speak to you soon.